This is our Forex blog for June 18th, 2012. And like we do most days, we want to buy the strongest currencies versus the weak and sell the weakest ones versus the strong. This is our sortable currency meter, which is based on our best tools. The top histogram shows how strong or weak the currency is. Anything at and above the dotted white line in green is super strong, and anything red is super weak. This is made up of 5 of our best statistical tools. 3 of them measure the direction the dollar, or in this case the yen, is moving versus all the rest, and the other 2 measure the intensity. So anytime you have not only the majority of yen pairs going up but with incredible intensity, that's a trend that's likely to continue. Underneath that, we have the 15-minute trend, hourly trend, daily, weekly, and monthly. The more time frames that are up, the better. But for intraday trading, you only really need the real-time histogram and maybe the 15-minute trend to be in your direction. The weakest one is the Swiss and the euro. And you can bring up the quote sheet to sort this, what percentage of currencies are trending up or down on the hourly chart. The Australian's the strongest, then the yen, then the dollar. The weakest 3 are the CAD, Swiss, and the euro is the weakest. So obviously, let's go over the 3-step easy Forex trading system rules. The first step in our 3-step easy Forex trading system, and both brand new traders and experienced traders can use this. Experienced traders will add extra rules like where's the next level support resistance and is it worth the risk based on how much likely profit I'm going to make. But for new traders, these are the 3 steps. 1, use the currency meter you just saw. You want to buy the strongest currencies versus the weak and sell the weakest versus the strong. Step 2, wait. We have put in Forex trading signals, which are based on our range bar patterns. And too many traders see a trend and want to jump on board. You know, if the trend's already gone up 30, 40, 50 pips, you need a pullback first. Or you need it to go sideways to prove to you that there's no selling, and then when it breaks out, it's likely to continue the trend. So you need patience and discipline. So you want to buy the strongest currencies when you see a buy signal and price goes 1 pip over the previous bar's high, or if it's already gone up a couple waves up, sideways, or up again, pullback, up again, 3 waves up, you might want to wait for the trailing stop to get hit and flip down below price and turn green, then buy. That'll eliminate some of the unnecessary losses. For the weak ones, you want to sell when you get a sell signal and price goes 1 pip below the previous bar's low, or the trailing stop gets hit and flips up above price and turns red. And for exits, inexperienced, brand new traders, or traders for smaller accounts, 25 to 50,000 or less, should use trailing stops for your entire exit. As you trade larger, you probably want to exit half your trade when it hits the first area of support resistance, and then trail the second half. So pause this, read these rules. These are key areas of support resistance in the areas that or in the order that I find them. And also keep in mind that markets most of the time, probably 80% of the time, do not go above or below the 1.618 fib target. As long as you draw a fib on a 30 to 50 pip swing, that holds true. If it's on a 10 or 15 pip swing, then fib targets are worthless. So watch our Fibonacci profit target videos to learn more details on that. And also, markets rarely ever go beyond the 2.0 fib level. If they do, 5, 10, 15 pips, then you're going to get a pullback. Doesn't mean that they won't go above that on the next wave up, but the first time they hit that level, it's usually going to pull back. So let's look for some of the trades today. Step 1 was just identify and focus on the currencies that are most trending. Ignore the rest of them. Common sense. Some people just trade the same currencies every day, and some days they do well, and other days they lose a lot. Typically, new traders lose more on down days than they do on their winning days because they take too big of losses and small wins. The whole purpose of trading with strong trends is that your odds of getting bigger wins are, higher. Instead of getting 5 pip wins and 10 pip losses, you're looking to get 20 and 30 pip wins and 5 to 10 pip losses. That's the key. So the euro is one of the weakest. The Australian and yen and dollar were the strongest. So the euro is on top for all these pairs. So you want to sell the euro dollar and sell the euro yen, especially after 4 o'clock right here when the 15-minute trend was down, the hourly shifted down, the daily shifted down, the monthly was already down. But the majority of the time frames are down at 4 o'clock. So here's 4 o'clock on the chart. We have the previous day's low right here. Unfortunately, this one was above the hourly moving average, and our systems pretty much look for buys above the hourly and focus on looking for sells underneath it. If you're an experienced trader and you're watching this, previous day's low is a very key area. Anytime it breaks underneath there, you're likely to get a trend down. Experienced traders, once they see it breaking the hourly right here, is a good trade. And then here's your first entry signal. It's already gone down from 175 all the way to 99.75. So it's pulled back about 100 pips. You might want to draw your fibs on the entire wave and look for sells at the 38 to 50% level. Here's the 38% level right here. This is where, you know, a little bit more experience can help a trader that's traded for a while and has also learned more. So here's the first sell signal after you're looking at it. It pulled back up from 78 all the way up to 05. Not a bad pullback. You can see it was extremely weak. You go short, and as it comes down, the trailing stop gets you out right here. You might have probably lost about 7 or 8 pips. In your second entry right here, you're also lost. The third one, and you can see when the trailing stops get hit, it can avoid some unnecessary trades some of the time. Like this one right here, if you had sold when it went underneath the previous bar's low, you avoid a small loss. When the trailing stop gets hit, somewhere around 100.08, it comes down here and gets you out right here with a 28 pip win. Another entry right here, notice tiny losses. Another entry right here at 86. We're still in that trade. It's already fallen down to 50. So you got a 36 pip win, maybe an 8 pip loss, 25 pip win, you know, maybe 7 or 8 pip loss twice here. The point is your wins are bigger than your losses. Experienced traders don't worry too much about winning percentage. They care more about profitable trades. Now let's look at the euro dollar. The dollar was also weak today, and it's pretty obvious what direction it's going to go. When you look at our build your own trend tool, which allows you to set your own weightings, time frame settings, and so forth, anytime you have a down move with incredible weakness followed by an up move with very little strength in comparison, usually that previous trend is going to continue. In this case, the hourly moving average is right near this Fibonacci area, key support area. Once it gets broken, you have a nice sell there. Pullback trade right here with a small loss. Another sell signal here if you wait for the trailing stop to get in. You're short this around 45. Out at 26, you made 20 pips. Another sell signal here and here. When you wait for the trailing stop to get in for the entry, you're short at 30, and it got you out at 01, so you made 29 pips. And basically that's it in a nutshell. You want to sell the weakest ones versus the strong, and anytime you see a lot of weakness followed by almost no strength on the up move, usually that trend continues. Now another thing you can do is use a little bit longer time frame range bar. This is a 6 pips per bar. Here is 11 pips per bar. If you are, you don't want to get in and out and try to hang on to trades a little bit longer, you could just look at a longer time frame chart. Once it shows up in the currency meter, go short, out, short, small loss, short here, small win, short here, 26 to 96, short here at 94 versus 76. So the bigger the number of pips per bar, the fewer the flips of the trailing stop up and down. Let's take a look at the euro yen on a longer time frame, 11 pips per bar chart. And you can use this as a filter for whether to take trades on the other time frame, just knowing where the trailing stop is. Short here, even before 4 o'clock, it caught that big move. Short here at 100, got out down here at 38, nice 62 pip move. So if you're a little bit longer term, you don't want to get in and out as much, have a little bit wider stop, you can use a bigger time frame. Now one thing that I do to look at that, I always look at longer time frame range charts too. I'm looking at the currencies and how many pips per day they move. The euro dollar and the euro yen move 120, 124 pips. Last week it was like 118. I think the euro dollar maybe it was 110 pips using, I think, the previous 20 days volatility. So that's how I came up with 11, but I didn't look at it last night before I put this up here. You might want to use a 12 pips per bar chart right now based on the slightly higher volatility. And the more volatile currency is, the wider the stop. And this is a very good way of kind of just keeping you into that general trend direction. Just a suggestion that you can use if you don't want to use the faster 5 or 6 pips per bar charts. Another reason why I frequently look at how many pips it moves per day and why I come up with 11 or 12 pips per bar. If a currency moves 120 pips a day, 12 pips per bar is 10% of that. So if you have a 3-bar move, you're catching 30% of its normal range. So 3 times a bar that's 10% of its daily range is about 30% of the move. So if you got short right here and you see 1, 2, 3, you got 30 pips. It's kind of going sideways, breaks down, 1, 2, 3. You can take 30 pip wins, or in this case 33 pip wins, while risking only 11 pips. So it's a good way of, professional traders always focus on bigger wins than losses, whether it's a much higher winning percentage or whether you get much bigger wins than losses. Either way, either method works. Or if you have a very high win percentage and you also have 2 times or 3 times bigger wins than losses, you're going to do a lot better as a trader than new traders that only worry about winning percentage and they don't do anything to focus on getting big wins. In my next example, I'm going to go over the dollar Swiss. The dollar was strong today, the Swiss was weak. You want to buy the super strong dollar versus a weak Swiss when you get buy signals. So let's bring up the chart. All right, so when the price was underneath the hourly, you mainly want to look to sell. Comes up to the hourly previous day's high, which is this swing high here. When it breaks out, you can see it went from 79 all the way up to the upper containment band around 20. That's about a 40 pip move. You get some buy signals right here. If you wait for the trailing stop, you can see you had a small loss, small loss. You got back in here at 99, out at 11. Pretty much got most of your previous loss back. Another buy here. You're in at 11, out at 30 for 20 pip. You're definitely up on the day at that point. And when it gets above the upper white band, this is where the market usually starts to reverse. So it really becomes, up to you whether you want to take these trades or not. Our trading zones start to show up when the market's at a very high probability reversal area and the market's moved too many pips during the day. So, it becomes more risky to buy when it's up here. When it first breaks out and just starts its trend, the first, second, third, fourth pullback, as long as it's, near the middle of the range or very high probability trades, the higher up it goes, the more likely it is to reverse. In fact, when it's above the upper white band, and especially when the green band gets hit, you can see a counter trend sell signal right here. Nice 15 pip drop here. Another counter trend sell signal up here at 65, pull back 25 pips. You want to trade with the trend until the market moves statistically too far above the white band, especially the green band, and then look for counter trend trades and ride it back down. You can see it just got another buy signal and started going back up.